Hello and welcome to today's episode of Nucleus Investment Insights. On the surface, the Australian market looks cheap relative to the world market. However, there are more factors at play as the Aussie market is dominated by resources and financials. Today, as the title suggests, we're going to reveal some disturbing truths about ASX valuations. Firstly, on the agenda, we'll do a global valuation overview and explain the metrics we use to value markets. Then we'll compare the Australian market to the world. Next, we'll look at individual stocks and sectors. Earnings season has recently kicked off in the US, so we'll have a look at what's been reported so far and what's still to come. And then, as always, at the end, we'll discuss the investment implications for markets. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hey, Sam.
Thanks for joining us today, Damien.
It should be a good one.
Yeah, it should be a good one. So just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform, and our shows are available on all the majors. One thing I just want to mention before we get started, if you'd like to look at the slides in more detail, we'll post them in the show notes after the episode, and you can also view these at nucleuswealth.com/webinars. So now we've got that little bit of housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you.
Yeah, thanks, Sam. So look, there's a couple of charts I want to go through. There's actually a lot of charts. It's relatively chart heavy today. I will talk through for anyone just listening in on the podcast. So you don't. Hopefully you won't have to download them. But I think there's a lot of value in jumping on there. So Sam will have the show notes and obviously the charts will be shown on YouTube as well for anyone watching this on YouTube. So I'm going to start with the forward price to earnings ratio background, and this is sort of, I guess, where this whole thing coming from is that there's a whole bunch of different valuation metrics that we use, and lots of other people do as well. The most common one, and the one that sort of has the least idiosyncratic issues, is the forward price to earnings ratio. So what it is it's looking at the next 12 months, and it's like a rolling number where every day that goes past, say for at the moment, we take a little bit less of 2022 and a little bit more of 2023. And so you sort of get this moving number in terms of the earnings, and we compare that to the price, and so that gives us some valuations in terms of the market. Then we can look at different stocks on it, and there's a whole bunch of other ones. Cash flows is really important for us, but it can be a little bit problematic comparing between sectors when you look at some of these cash flows. And we use a lot of our own definitions to get to those numbers. So in this presentation, I'm mainly going to use earnings just because the numbers are a bit more. You can point back to what other people are showing as well. You'll also look at sort of various measures of book value and all these other factors. But for the moment, I'm going to talk a lot today about the forward price to earnings ratio, not because that's the only one, but just because that's a pretty good indicator, and it's generally not giving at the moment too many different signals to what we're seeing elsewhere. So this first chart I'm showing is the forward price to earnings ratio of Australia divided by the forward price to earnings ratio of the world. And so you'd expect there that if they were always exactly the same, then this line would come out at 1. And for anyone sort of listening in, it sort of was well below 1 back in the sort of early 2000s, sort of rose up, and it's oscillated pretty much between 0.95 and 1.05 for most of most of the last 20 years. The average is about 0.95. And at the moment, we're trading sort of a little bit, a reasonable bit below that, sort of 5% below that sort of longer term average that you'd look. And so, on that basis, you'd look at the Australian market and go, well, yeah, it looks relatively cheap. It's your thoughts on the growth outlook and things like that for Australia. But at face value, you'd say it's cheaper than what it usually is. And so. So therefore, there's not a particular reason to avoid Australia versus international stocks.
Damien, just quickly, what do you mean by the world? Which market are you looking at in particular?
Yeah, so what I'm doing on this one is limiting to the largest stocks. So we've got I'm using the MSCI World, which is about 1,600 stocks globally, and across all developed markets. So I'm not throwing in the undeveloped markets, so places like China or India or Brazil. So it sort of avoids those companies and just looks at developed markets. And I've done the same with Australia. Just the stocks that are within that sort of world group, which is about 60 or 70 stocks, but pretty indicative of that makes up, to give you an idea as well, it makes up about 80 to 90% of the total market in most of these countries. So it's a smaller group of stocks, but they're so big that they make up most of the investment universe.
Awesome, thanks for that.
Yeah. So what we're going to find though is that it's not all as it seems. So I will get there, and I'll come back to sort of looking as to why this is giving us a particularly bum steer at the moment, this metric. But let's get there via sort of looking at the world as well and sort of what's going on in terms of profitability and earnings. So the first thing I'll start by is just sort of jumping to a valuation chart now, just sort of showing over a similar, just the last 10 years or so of the Australian market versus the S&P 500, so the US market. And I guess the key thing here is just sort of highlighting that we've had this real bubble that we've been in the last little while, where valuations have been significantly higher than what they usually have been. It's come back to more reasonable levels, but it's sort of, in terms of the US, it's probably sitting at its averages for the recent time, and Australia looks a little bit below its averages. And again, let's jump into why a lot of the spoiler is a lot of that is energy at the moment, but we'll move into that as we go. So and the other thing I want to highlight with this one is that so yes, valuations are back to more normal levels. The question is always there's two ways that you can see this ratio change. One is that the price changes, and the other one is that the expected earnings changes. And that's the key for us at the moment is really looking at those expected earnings and seeing what changes we're going to see within that, because that's what can really drive this and change change what you're seeing. And I've got another chart which is sort of showing what that means, and I'm sort of calling it exuberance or prescience. And so the idea is that there are times, and the early 2000s were certainly some of these periods where what you saw was the earnings. So the markets were relatively expensive. The US market you'd pay sort of 16 times to 18 times for, so above the average. But we actually got all this earnings growth come through. That's the red line on this charts, showing that although markets looked quite expensive, all this earnings growth meant that they actually became much cheaper. And a similar thing happened around 2008. They weren't particularly expensive, but certainly they'd risen in terms of looking more expensive coming out of the financial crisis. But that sort of went away, not because the price fell, but because the earnings were so strong that it made it up. And then similarly again in sort of 2017, we saw that same thing again, where that really, really strong earnings growth was what brought back valuations to more normal levels. That sort of hasn't been the case as much in this latest one. It's certainly there's been an element of it. So prices jumped to quite expensive levels, and then we saw earnings really come through in the early stages coming out of the pandemic. But then over the last couple of months, we've seen that earnings growth has over the last year, that earnings growth has really died away, and that's where it's basically been all prices that's bringing that down at the moment. And so if you look at that over a longer period of time, I've got a scatter plot sort of just showing how that sort of affected is that if you do have high price to earnings ratios, generally that means you do get earnings growth. So there's certainly an element of prescience to it. It doesn't mean you get price growth though. So if you look at so if you buy on a high multiple, so you're buying on 17 or 18 times, it is more likely that you will get earnings growth come through. So that left-hand chart, we've got this positive sloping line for that. So there's a relationship between the higher the multiple you pay for stocks and then what the earnings you get is. But then if you look at that versus the price growth, you actually see it's a slightly negative sloping line, which is basically saying, well, yeah, if you quite often people pay too much though. Like the earnings growth comes through, but it's a matter of people paying too much, and there's not it's certainly not a relationship that you'd say there's a strong relationship on terms of price. So, and what does that actually mean? Does that mean there's no relationship between price and valuation? I say no, absolutely not. There is a relationship between price and valuation. It's just that you can't tell just by looking at valuation alone. You need to be looking at other factors that are going into it. And certainly the issue we have is that analyst forecasts at turning points tend not to be very good. And the question we have is that, are we at a turning point right now? And so what do I mean by that? When you go through these macro events where you've got these rapidly rising interest rates, is that you find that the companies are often the last ones to start downgrading their forecasts. So the macro strategists and people looking at the larger market will be looking and saying interest rates have risen. The surveys about whether it's consumer confidence or whether it's about what the activity that's going on in the economy, like the information that's coming out that's very, very current, is all starting to turn down, and so therefore earnings are going to turn down as well. Whereas companies tend to build it from the ground up. They go around and ask all their salespeople, what have you got in the pipeline? How much are you expecting to sell the next quarter? What's the, and then they add them all up, and then they come up with a number at the top. And those salespeople aren't sitting there thinking about, interest rates have just been risen at a record speed. That's going to take a few months to start flowing through, but once it starts flowing through and there's this effect of house prices and the wealth effect and all that, they're not thinking about that when they're thinking about their forecasts. They're just thinking about, I did first quarter, we did 10% more than the prior first quarter. Second quarter, we did 10% more than the prior second quarter. I've still got a book of people, it'll probably be 10% again. And that's sort of, they're not thinking about those macro expectations. And so if we're not going through a macro change, then analyst forecasts are pretty good, and certainly in a relative sense, companies versus other companies, it's still important. But I guess that the main point I've got is that the earnings turning is the most important factor at this point in the cycle. I'm going to break that out in one more way. So there's a way you could look at prices, which is to break prices into these various factors. So we're talking about this forward earnings that I spoke about. So and how every day we're using a little bit more 2023 and a little bit less 2022. So what that means is that if we go forward, if we look over a 12-month period, we could sort of disaggregate the change in price into 4 different factors. One is, what was the growth that was expected between 2022, say, and 2023? So, because we're going to go from having, at the start of the year, we'll have all of 2022 and none of 2023, and you roll forward 12 months, and now we're looking completely at 2023. So there's this growth that's already expected in earnings. Then there's a revisions, because analysts might have been expecting 12% growth, but by the time they got round to that year, now they're actually only expecting 8% growth, or vice versa, up or down. So there's the growth that's expected, there's changes in that growth expectations, and then you get that earnings surprise. So there's 2022 came in, surprised everyone, and came in higher or lower than expected, and that sort of set your starting point, either higher or lower. And last of all, you have the change in valuation multiple, and that's sort of that's the part about why I like to look at this in a disaggregated way, is because I want to see where is the growth coming from. So in times when you've got in times when you're looking at strong markets that are growing strongly and it's all coming through from the price multiple, that's when you get a little bit concerned, or you start to work out, or you have to look and say, well, what's that telling me in terms of expectations? So I've got a chart that sort of decomposes these over the last few years, and you can see for the 2000, I'll start in the middle of it, the 2020 year. So you saw that earnings surprise in 2020 was actually this huge negative. So earnings fell by 30%. the growth in earnings was pretty good. There were some slight negative revisions, and then we had this huge rise in multiple. So, and this is all from 30 June. So it's the idea that yes, earnings had fallen, but analysts were all from a valuation perspective, people were quite positive about what was going to happen over the following year and how the growth would push through. And so the multiple went up, and then the next year we actually did see that growth come through. So we saw that 27% increase in terms of revisions. So that's, when I say revisions, that's earnings that are revised upwards. They thought it was going to be a 10% growth, and it ended up being a 37% growth. And then you get there's growth, and then the revisions was up 12%. Sorry. And you had that huge growth, 27% growth from that year, sort of recovery from the pandemic. The latest year, we've actually, there's been a little bit of earnings surprise. We've got decent growth sort of built into that market. Revisions have actually been not too bad. They've been going up, but it's all been that multiple coming off. So, that sort of may or may not give you your cause for hope, depending upon if you're bullish on this and you think the earnings are stable and the earnings are going to hold as where they are, then this is a type of chart that would say, yeah, we should be getting out and buying now. If you're worried that the earnings are going to keep falling, then then you might think, well, okay, it's obviously better than where we were, but you might want to leave it a little bit before you actually jump in and do that. And so the next chart I've just got, which sort of breaks out that into it's exactly the same chart, but just broken out separately in terms of saying, well, what's the cumulative effect of this forecast growth versus the earnings surprise and the change in forecasts. And I guess the point I'm making with this one is that the leftmost one, that forecast growth, that's where most of the positive return is coming from. And then you've got this earnings surprise that happens that sort of takes away most of that. So the way I'd sort of pitch it is, a lot of the time you're talking about analysts start with sort of a 10-15% earnings growth, and then earnings surprises, they're too positive, and then earnings surprises sort of pull that back to a more normal level. But then you get some revisions to forecast it, and that sort of leaves you in a positive place. And the net effect of those changes in PE multiple should roughly balance out. So, and as we saw on those over the longer time. And so as we saw on those ones, we had that massive rise in 2019 in the PE multiple, and then we've sort of got it all back, taken it all back in the most recent year. Okay, so that's valuations sort of as a broad picture about how we're looking at them. The next part then is looking at the distributions of those valuations. And I've got a chart up here which is sort of showing the 12-month forward PE, and there's a grey sort of shaded section in the middle, which is the between the 25th and 75th percentiles. So basically 50% of all stocks sort of sit between that range. The blue line's your median PE, and then the two black lines are the most expensive 10% of stocks and the least expensive 10% of stocks. And it's actually really interesting what's going on at the moment, is because we've obviously been through this big bubble part. You can see with that black line, went from call it 30 to 35 times. This is the most expensive stocks in the market, went from 30 to 35 times up to sort of 70 and 80 times. And then it has fallen back, but it hasn't fallen all the way. Like, it's sort of back to that, now it's in the 40 to 45 range, which is about 20% above its longer term sort of median number in terms of what you're expecting. So expensive stocks, while they've come back, they're still quite expensive. At the 75th percentile, it's a similar story, but not quite as extreme. But they're sort of still 7% above where they trade over the longer term. The median stock is pretty close to its longer term average, and then the cheaper stocks are actually cheaper than they usually are. So I guess what I'm saying in the end is it's a wider distribution than what you usually get. The expensive stocks are more expensive than they usually are. The cheaper stocks are more cheaper than they usually are. And a lot of that cheapness is the sectors that are like the energy sectors and the resources sectors. but not all of it. There are other sectors in there that are some of the other that are affecting this on the downside as well. And they might skip Sam forward. There's two charts. Just skip forward to the sort of two charts side by side that are showing effectively the same thing. That just those two numbers. Yeah, so you can see them. Just those two lines broken out. The cheapest 25% of stocks and the most expensive 25% of stocks. That's into those. Okay, so that sort of gives us an idea that what's going on in terms of those distributions. So there is potential there, and now it's a matter of saying, okay, well, let's take the next step and let's dig into saying, well, which are the sectors that are cheaper than what they usually are, and I've broken that out into sort of just some really broad sort of 6 sort of high level sectors that I sort of call technology, which is anyone who's sort of producing newer, whether technology services or health technology and things like that. Resources, which is your energy and your mining sectors. Consumer, which is anyone who's sort of face to face with consumers in terms of retail stores or producing sort of non-durable goods or producing goods. Sorry, your finance side, which is your banks and insurers, manufacturing and services. So the finance side, so you can see on this one that the two lines right at the bottom, resources and finance, are basically always cheaper than the rest of the market. And so what I'm doing here is, again, dividing this by the world, so that if you're sitting on one, then you're basically the same as the world. So finance is cheaper than the world, but it's always cheaper than the world. Resources are cheaper than the world, but they're usually cheaper than the world, and they're quite volatile. And the issue with the resources is 12-month forward PEs probably aren't the best way to look at these stocks, because the prices are volatile. You do go from $100 oil, or so over the last few years, we've gone from negative oil to $120 oil and back and up and down. And so when the oil price is negative, nobody's sitting in there and looking at the company saying this company will never have a business ever again. It's all negative. They're looking at it saying, no, the longer term price for oil is whatever Y, and the current price will, eventually you'll come back to that longer term. And the same happens on the upside when the prices hit extremely high levels. People are then sort of bringing them back. So the stocks look like they're cheap, but they're not as cheap as what they look. And then in other times they look like they're expensive, but they're not as expensive as what you might think. And so you can see, like within this, the technology sector, it got very expensive. It's still quite expensive. It's not as cheap as it usually gets to. And consumer sector is roughly about where it's always been, and the services is sort of about the same as well. So the story, I guess, is that manufacturing looks a little bit cheap relative to where it usually is. And I would argue that that's because there's been this boom in terms of goods, and so manufacturers have been producing more than what you'd expect for the last little while, and so so because they're producing more than what you'd expect, what you'll find is that they'll look like they're people will be looking at them and assuming that they're going to come back in terms of the cost. You might just need to mute too, Sam. I think I can hear a small child in your background.
Yeah, apologies about that.
No worries. The perils of work from home. Yes. So resources and banks really cheap. Manufacturing a little bit cheap. Technology a little bit expensive, and the rest of the sector is about normal. Is sort of like is a rough guide. So then I thought, well, let's have a look then how that fits, and I've broken it differently again, just to sort of keep showing, I guess, different looks at these. Is that now I'm using the GIC sectors and just sort of looking at different regions of the world, and the key thing I want to highlight with this graph is actually looking at this Australia-New Zealand column that sort of flows through it, because if you look at this Australia-New Zealand column, and excluding real estate, where the US is a lot more expensive, but and then Eurozone Europe is more expensive than Australia. So Australia is sort of third most expensive on real estate, but pretty much every other sector, they're either at the top or first, second, or third in that. And so, as you dig sector by sector, you can really see that the Australian market looks more expensive, and that's at odds to that first chart I had, which was where and I've got that coming up next, which is saying that the Australia versus the world ends up being below not only below average, but below its own average, but also well below the sort of the world market, sort of almost 10% cheaper than the world market, and that's sort of very much at odds at what you see in that the prior one, where it's saying as you go through every sector looks more expensive, and the reason why is because Australia has a huge weighting to those two sectors I spoke about earlier, the resources sector and the financial sector. So both of those sectors always trade on a discount to the market, and the reason why is because banks are these hugely leveraged assets that have lots of risk assessed to them, and so they tend to trade on lower multiples because of the amount of leverage within them. And then secondly, resources have this. The price earnings ratio, as I said, isn't as important as, because it's a very short term look at these assets which have these very volatile prices, and so the price that people are willing to pay for resources doesn't always equate to its 12-month forward, and even on a longer term, people will tend to pay less for those stocks because they are very volatile. And that's the reason why we're seeing what we're seeing. So the next chart, which is, I guess, the more important one, or the most important one here, is basically saying, okay, let's have a look then. Let's take Australia and exclude banks and resources, and then look at that relative to the world, excluding banks and resources as well. Now, in this case, we see that it comes out to about 1.06 in terms of the long-term average. So the Australian market is usually about 6% more expensive than the world market. At the moment, it's closer to 125% more expensive than the world market. So we're basically, I've got a line in there showing that the 90th percentile. So it's in anything above that line is in the top 10% of how expensive Australia's got, and you can see that it is very expensive relative to it's well above that line. It's sort of, I don't know, maybe it's in the 97th or 98th percentile of where it's traded throughout history. Australia looks expensive relative to the rest of the world on that basis. And then saying, okay, well, I've excluded some things, so let's just make sure that what the story I was telling you adds up. And so then I've got another one which is showing you Australian banks versus world banks. And again, on this case, the Aussie banks are they're 50% more expensive than world banks. And it's the same story. They're just way off that scale in terms of what you'd expect, well above the 90th percentile of where they've traded, and more expensive than they usually are. And then finally, the Aussie resources versus world resources is about it's slightly above average, but it's nothing special. It's sort of so we've got those three different categories. My first thought was, in terms of seeing that chart with the Aussie banks, ex banks and resources, was, look, maybe there's a few other stocks that are causing this to happen. So CSL is a very big stock, especially once you exclude banks and resources. CSL makes up this huge proportion of the Australian market. Maybe that's doing it. Doesn't really make that much difference if you don't knock that out. It is very much, if you go through sector by sector, Australia has got a lot of expensive stocks. I've thrown up a couple of the ones. I ran out of time as well. I didn't mean to do more of these, but I've thrown up a couple of these lines just to sort of show you. Telstra's trading on almost 23 times earnings, and the top 10 other stocks in the globe. It's number 2 in terms of being most expensive. Most of the other ones are trading at roughly half of what Telstra's trading at. If you look at Cochlear and CSL and compare it to a whole bunch of the other major healthcare stocks, similar type of story. You go into stocks like Brambles or Transurban, or you tick your boxes. You go through. You can find for most of the stocks they'll be trading at in the upper range of where you'd see these stocks when you compare them to stocks around the world. So so the net effect is, the disturbing truth about the Australian market is, it looks cheap at face value if you just divide everything through, but if you actually start comparing like with like, it does not look cheap at the moment, and that looks at quite extreme levels actually as well, not just the sort of it's a little bit it's expensive as it's been for the last the last year or two as COVID's hit, but it's actually getting to very extreme levels of which you usually expect that there's either been a structural change. Now Australia is a much higher growth than everywhere else, and it's going to continue to trade at these lofty multiples, or you will get a snapback. And I can't think of a reason for a structural change. And I do think there's a lot of risk in terms of Australian households being having way more variable loans than other countries, and seeing and way more debt as well. And then we've seen the interest rate rises that have come through. Another one again this week. That's just going to be smashing into consumer demand.
So, Damien, a couple of questions. So, the Aussie market looks cheap compared to the world market, although the Aussie banks look expensive to world banks. So, how does that fit in? What's going on with the world market to still make the Aussie market look cheap, although our banks are really expensive?
Yeah. So if you add the finance and resources together, in the world, then you get sort of about 15-16% of the world is somewhere in finance or resources. In Australia, we're talking well over 50%. So basically, what it is Australia has, when you do your average, Australia's got more than 50% in these sectors that always trade cheap, and then the world's only got 15% in that. So when you multiply it out, I can provide the maths for anyone who's struggling with the concept.
Yeah.
Maybe I might put it up in a slide just to sort of show the average levels and how you get there.
Yeah, I think that makes sense. And one other question, in Australia, it's quite unique in terms of the amount of superannuation that pours into the Aussie market. A lot of the funds have quite a high allocation to Australian stocks. And, the market might seem expensive compared to, maybe a decade ago. But, do you think that's a reflection of all these funds that are just pouring into the market all the time?
And the other one's franking credits as well, is that Aussie investors love their franking credits. And so, there's an argument that they overinvest in Australia in search of the franking credits. And potentially that's true at the margin. Both of those may be true. I think in terms of the super funds, there's certainly a lot more super funds investing offshore than what they used to. So if you look at the asset allocation ranges from 10, 15 years ago of super funds and compared it to today, almost all of them have increased their exposure to international stocks. International stocks have become much easier to trade, much cheaper to trade. So and so the retail amount of the amount held in retail accounts is higher than what it used to be. So so from that perspective, I think if you look over the last 10 years, say, of some of those charts I had up there of saying, I think they're probably a little bit more indicative of where it would trade. And I think that even if you look at over that time period, they still look a lot more expensive than what they usually do. So let's say the banks, for example, if you just looked over the last 10 years, the banks probably trade on about 25% more expensive than their global peers. Now they're over 50%. So it's it's sort of it's another leg up. And if you looked at, say, the banks, Australia versus ex-banks and resources, you look over the last 10 years and it probably comes out to be about Australian stocks probably trade about 10% more expensive than their global peers. Now we're trading 25% more expensive than our global peers. So even if even if there is a grain of truth to those, it's certainly more extreme now than it's been anytime over the last sort of 20, 25 years.
Okay, nice one. Thanks for that. That's interesting.
The final thing I just wanted to jump in was reporting season. So now this is all pretty current because there's like 100 and something odd stocks reporting today in the US. So there's still a lot of things moving, and still trying to take these numbers with a little bit of a grain of salt, because haven't had time to check into to all of them to make sure they're all sort of adding up the right way. But if we look at the reporting season so far, it's been all right. I tend to look. Important to notice with reporting seasons is you have this idea of earnings beats, they call it. So they come in and they say, 80% of stocks are beating what their targets were, beating what their forecasts were, and stuff like that. And it always sounds really impressive. The issue is it's usually a lot of that's the case of people lower the bar and then manage to step over this nice low bar. And so to give you an example, a company with a 30th June balance date, you get to pretty close to 30th of June. The management have their own internal figures. They'll be looking at their numbers and they'll be going, okay, we told the market we're going to earn $1. Actually, we're only going to earn about 90 cents. So they'll come back to the market and say, they'll put a press release out because they've got to keep everyone up to date and say, okay, we told you we're going to earn $1. We think it's probably going to be closer to somewhere in the 90 to 95 cent range. We're still doing our accounts and we'll let you know once it's all done. And so now analysts all downgrade their forecasts. So from $1 back to whatever, 92 cents. They downgrade their forecasts. A month later, the company actually comes out with its result, and it comes in with a 93 cent result, and that's a beat because everyone had 92 cents in their model, but the company comes in with the 93 cents. And the so what we try to do is, first of all, we look versus a month ago. We say, well, let's have a look a month prior to the results first, and just see what's happened in terms of the surprise side. And then secondly, we look at earnings forecasts, because the other thing is, companies do a lot of adjustments to their numbers, and sometimes the beat is because they've got a profit. Sorry, they got a profit on the sale of an asset or something like that you weren't expecting. It's not a recurring number, and sometimes and often that happens on the loss side as well. And so a better indication is saying, well, what happens to forecasts? Does the forecast go up or down? And do the 2022 number forecast and then the 2023 forecast, what do they do? And on that basis, I've got a chart up, or a table, sorry, just showing some of these. So in terms of the surprise, US and Europe are both coming in about 7% above expectations. This is just the quarterly surprise. Sorry, I've tagged that first quarter. It's actually second quarter. Asia's a little bit behind at the moment. There's, in terms of the 12-month forward forecasts have been increasing, but if we dig into the actual 2022 forecasts, the median stock hasn't been changing. And if we're looking at 2023, the median stock has had a slight downgrade in terms of forecast so far. So net effect is actually, that's not a bad reporting season so far. If you dig again into the next level, I've got another chart which is showing the same thing but broken up by the GICS sector that it's in, and you can see that almost all the positive stuff is coming from energy. So energy is roaring in terms of forward forecasts, and then downgrades are more likely in other sectors. So materials sector, for example, is one in particular, and that covers both building materials and mining. Is on average seeing downgrades. We're seeing some downgrades to financials, and then of the extreme side. So again, this is a percentile range where I'm saying the top of it is the worst companies, the 10% of the worst companies, and the other end's the 10% best companies. The other thing you'll notice is the upgrades tend to be quite small upgrades, whereas the downgrades have been quite large downgrades. So for example, at the 75th percentile level, most of the stocks, if they have upgraded, it's been between 0 and 1%. Whereas if they've down at the 25th percentile level, the downgrades have been somewhere between 4 and 8% in terms of the downgrades. So so I guess the point is, yes, the overall report season's been all right, but actually most of that's been concentrated in terms of the energy sector. We are starting to see some signs of weakness in some of these other sectors, and that's, I guess, we think that sort of fits with our narrative. We'd be expecting to see a little bit of weakness at the moment, and in terms of these earnings figures, and then over the next 3 to 6 months, if we're right that earnings are turning and we're going to see some further downside, that's when we're going to start seeing it. So we're expecting initial indications now, and then the next 3 to 6 months, really to start to see these downgrades start to take hold. And so so it's sort of in my mind, it fits with our narrative of things don't look that positive in terms of the earnings side, and the valuations are about average. But that still means that if we're right, then earnings fall, say 10, 15, 20%, then you're likely to see some of that multiple come off as well. And that's where you can see, earnings fall 10%, multiples fall 10% as well, and you end up with a 20% decline in stock markets pretty quickly, as your risk cases.
Okay, that's great, Damo. We've had a couple of questions come through. So we've got one question here. I think you've answered the first half of the question. It's a two-part question. He's asking what the quickest and most reliable way to value an ASX company. I think you've said forward price to earnings ratio. Do you want to elaborate on that at all?
Yeah, I will. Look, it does depend. Resources companies, banks, that's not necessarily the right way to look at it. Actually, more resources companies, it's not. I'd be more wary about valuing it on that basis. You can do discounted cash flows, so they're sort of your the most complicated tool that most people will pull out. The real issue with discounted cash flows, and I've got some posts up over time that sort of shown where I've shown these types of things, is there's so many little things you can do to discounted cash flows to make the numbers look better or worse. I've got an example up on the website where I basically change everything in the decimal place behind that you can see. So, for example, the beta that I'm using, I go, okay, well, it's a beta of 1.1 for both of them, but one of them I use 1.05 and the other one I use a 1.14. And then I look at the growth rate, and they're both growing at 5%, but one of them's growing at 5.4%, the other one's going at 4.5%, and just going through those ones. And you can basically double or halve valuations by changing things. Because you've got a lot of little variables, and you just change everything this tiny little bit, and the valuation looks fantastic. And then you change everything a tiny little bit down, and it looks terrible. So discounted cash flows are great if you are using them yourself and you think you're being honest. If you're looking at somebody else's discounted cash flow, I'd be very you want to be really careful. You're looking through each and every assumption, and because if every single assumption is just that little bit more positive, it can make an extreme difference to it. And so then then you sort of have to look through. You've asked a question. Within that question is asking how to value small cap companies on only potential earnings. Look, you really do need to look at the market size and what your expectations are, and handicap them. So you can sort of look along the line and say, yeah, look, I think these guys they've got this great product. They could get to a 2% market share, and that would earn this much revenue and on this much margins, and that would put them on if we put them on a market multiple at that point, here's how much the company would be worth. But then you need to sort of discount that and say, well, what are the odds to actually make that? Okay, is that a 10% chance? Is it a 20% chance? And so a lot of that is just sort of that handicapping of different positions within those. And the other one, I haven't really mentioned cash flows. We spend a lot of time on cash flows ourselves. I've shown earnings because at least earnings, you can look at my numbers I've shown up here and look at other people's own numbers that you might see from other brokers or other sources, and they'll match. Whereas because we use our own internal measures of what we think cash flows are, you can see some differences in terms of those, but the cash flows, if you get them right, give you a much better indication of what's going on for companies, wherever you can get to.
Excellent. Thanks for that, Damo. So this is our last call for any final viewer questions before we get into the investment implications. So just drop them in the chat below and we can answer them after this segment. So now we have our viewer question of the week. So this is for viewers to have some discussion in the comments section over the coming days. So the question for this week is, will you still buy Aussie stocks at these valuations? So like I said, feel free to post your thoughts, engage with us and some of the other viewers over the coming days. So yeah, now we'll jump into the investment implications.
Yeah, so So we're seeing these inverted yield curves signaling recession ahead. We think that is a genuine sign, and that there is genuine risk that central banks have moved way too far too fast. We've seen Australian mortgage rates are up now close to 40% in terms of the amount of your payment that you had before, or you had a year ago versus the payment that you'll have today. We think that's for the second most indebted country in the world, that's a huge deal, and that's not just in Australia. It does affect other countries as well, but Australia is actually sort of is more at risk due to the nature of the debt market and the nature of the mortgage market. So, our take is that stocks are still expensive, and I probably shouldn't have left that word "very" in there. They're expensive given the declining earnings prospects. They're probably no longer very expensive. This was probably from a few months ago. We probably haven't eased that word out yet. In terms of the what's happening in terms of the Fed, and so there's a question as well in terms of that. That last night they're signaling they're going to be, I guess, a bit more watchful and maybe not as keen to keep raising. But what it has done though is it meant they're not there to back up markets at the moment, and particularly markets that are falling the way they're falling at the moment. My take is that the Fed and the Australian central bank have sort of become a little bit bubble managers because they're relying on asset prices to do a lot of their work for them. And we've seen in the past, when earnings or when markets have fallen quite sharply, we've seen that the Fed stepped in and given support, or the Aussie banks have sort of stepped in to support the market. That's not happening at the moment. That's actually the opposite. Inflation means that they can't step in, and if we saw a 30% fall in the S&P tomorrow, though, I'd expect that the Fed would turn around and change its view and start to help out a little bit. But if you see sort of this gradual grind down of it falls 30% over a year or 2 year period, then the Fed's much less likely to come in and help on a gradual grind downward rather than this sharp crisis type event. And I think that's what we've seen over the last 6 months, is that US markets have come off 20%. If it had to come off 20% in one hit, the Fed would have thought about what it's doing a bit more, whereas that grind downward has sort of left them, and the inflation that's happening. And so we probably do need a commodities bust in order to see the Fed sort of ease up. We are expecting the Aussie dollar to keep falling. So we saw last night, and the Aussie, or yesterday, the Aussie dollar came off again. That's the US dollar rising and the higher interest rates in the US and a more aggressive central bank is causing other problems. And we do expect stocks to continue to capitulate, and while we're in a bit of a bounce at the moment, we do expect that will, as earnings start to see the effects, that will come off. So might leave it at that, Sam, unless there's any other questions.
Yeah, we've got a couple of questions that have come through. So one from John. He's asking, has the recent Jerome Powell commentary signaled a change in the pace of rate increases and the strength of the US dollar versus the Aussie dollar?
So on the first part, yes, I think in terms of change of pace, it's certainly it's good to see there is a little bit more open to changes, and that's why we saw the US market rally last night. So that's on the positive side. The strength of the Aussie dollar versus the US dollar, it's a question about is the Australian market sort of following the US market, and sorry, it's the Australian central bank following the US central bank, and we largely think it is. And in that case, so we would expect that if the US central bank slows, that the Aussie central bank will also slow in terms of what it's doing. So I think at the margin, I think we're certainly right. We're not as positive on we're not as convinced that the Aussie dollar is falling as far as what we might have thought the day before, but that's only very much at the margin, and the general trend of a strong US dollar is still in our very much what we're investing for.
Okay, great. And we've had another one come through from Cam. So he's asking, do you still think the time's right to lean into bonds instead of equities?
Absolutely. Yep. So, if we're right, we're going to keep seeing, and you're seeing, said doubt starting to creep into the mind of central banks. We think that doubt's going to keep growing, and eventually that'll come into them pausing sooner than what they thought. And if we're right on the earnings side, then they'll see them reversing. And so that's all positive for bonds. And the idea is, you're buying your bonds, taking advantage of the falling yields. So falling bond yields means rising bond prices, and then with the idea to switch back into stocks at some stage. So that's the plan, and we'll see how it plays out.
Excellent. So we've had a few comments coming through. Usual comments thanking you, Damien, for the content. And that almost wraps us up. So I want to thank you again, Damo. Thanks for sharing your insights.
Thanks, Sam.
Great. So we do welcome your feedback on this podcast, especially in regards to future topics. So if you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me or one of the team. Don't forget to like the video now. And if you got some value out of today's episode, we'd really appreciate it if you please can share it with them. And also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with us, you can follow us on all major social media. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.